Welcome back. Now we've lined up for you a very interesting discussion on a report that has come by from Knight Frank, where they've said that retail sector in Tier 2 cities has been relatively under-penetrated as compared to Tier 1 cities. But the opportunities is, what we are looking at in the entire retail space, more so now in Tier 2 cities as well. Expected to grow at an 18% CAGR for the entire market between FY28 and FY29. To discuss this more about the retail space in India, we have Ghulam Zia, who's the Senior Executive Director of Knight Frank India, joining in. Thanks a lot, Ghulam, for joining in. The total shopping centre stock of almost 125 million square feet across 340 operational assets, of which 77% belongs to Tier 1 cities. So, do you believe or belong to the camp that the next leg of growth comes in from Tier 2? Or do you believe that where there is, concentration and consolidation, there is higher penetration and room for more growth there?
To start with, I would say, focus on Tier 1 shall continue, because if we are looking at a few of these malls which are falling by the wayside in Tier 1 cities, it's for various reasons, but your profitabilities are much higher in Tier 1 cities. But that's it. Tier 2 cities, as you rightly pointed out, which with barely 1/4 of the overall stock in 30 top cities, is in Tier 2 cities, and that's definitely a concern, where in most of these cities, you would not have more than 2 malls, out of which one would be performing. So when I'm talking about some 21 to 22 Tier 2 cities, amongst them, on an average, you don't have more than 2, 2.5 or 3 malls maximum. And that definitely talks about a lot of possibilities, and especially with wealth penetration, wealth percolation going into the semi-urban areas, I'm sure the propensity to spend is also going to be shooting up in Tier 2 cities. So definitely the Tier 2 cities is going to be a long journey ahead, and very good story for the retailers to look at.
Okay. Ghulam, hi, welcome to the show. Well, that's exactly what I wanted to talk about, is this surge in ghost shopping centers. And correct me if I'm wrong, but those are those shopping centers where the occupancy or the vacancy rate exceeds 40% and the occupancies are low. So can you give us a sense? There's been a 59% surge in these ghost shopping centers which have taken place. That means that there's a lot of real estate which is possibly freed up. Is that seeing traction? What kind of redevelopment are we going to see in these areas?
See, first of all, as you rightly identified, ghost malls are to be seen from the right perspective. Wherever occupancies are dipping, vacancies are shooting up. As we talk about 40% plus kind of vacancies are coming into that category of ghost malls. And the problem is, if the vacancy exceeds more than 25%, the mall is not going to make money. So when it is crossing 40, that means it's as good as dead. And that's the whole problem. When we are looking at how the growth of these centers is happening, we've categorized them into 3 different buckets: grade A, grade B, and grade C. About 132 malls fall in that category, which is C grade categories. And in that category, the average occupancy, average vacancy is crossing 38%, which was 32% last year, which means they are going down the slope, and definitely require some different way of rejuvenating them or bringing them back in some other avatar, which is what is also happening. In many of the places, the malls are giving way to office buildings, because office as an asset class is outperforming for last at least a year and a half or 2. And going forward, we do see a good progress for the office stock to office occupation to continue. So that's obviously one of the easiest thing to do is to convert them into something like an office, because residential is not possible. The kind of floor plates, etc., you cannot convert them as it is into residential unless you demolish them and reconstruct, which is also happening. In a few cases, we have been watching demolitions happening to give way to some other asset class. But as you rightly said, if I look at land and building valuations together, we are staring at about $2.5 billion US amongst those 56 or 57 assets that we are talking about, which are already dead or ghost malls. And we are looking at that number growing in times to come.
Right. Okay. I just wanted your thoughts on the rate at which supply will grow, because when we speak to companies, they speak about, wanting to grow their revenue share, wanting to expand their stores, wanting to, increase the stores that they reach, etc. as well. There seem to be a plateauing out in the supply that is coming, and also from the supply that is coming, you're saying that a lot of them are turning into ghost malls. So Is that a problem? That can that be a speed breaker for the retail growth?
I won't say so. The problem, if at all we are focusing on the non-performing malls, we must also look at the performing ones. About 47 to 48% of overall malls that we're talking about are in A grade category, where the vacancies are below 5%. As a valuer, if I'm looking at these stocks, 5% is a saturated vacancy. Here in these malls, it is below that, which means retailers are queuing outside these malls to find some space to put their merchandise or show their stuff to the retailers, and that is not happening. And that number is also growing. So whenever the new malls are coming up, the new stock that we're talking about, most of this new stock is actually fulfilling the requirement of the new buyers. And what is that difference is what I would quickly take a minute to explain. On the other side of COVID, we realized that we could rely on e-commerce to do our consumption. But then what was differentiating e-commerce from the brick and mortar retailing was actually touch and feel, experience. And that experience, unless you give it to the customer, the malls are going to be on the downslide. And that's what is being observed. Even if a lot of those malls which are aged, which are old,
Sure.
need to rejuvenate and come back in a new avatar. And that will continue to happen in times to come.
All right, Ghulam, just before we let you go, just a quick brief comment from you. Is this the peak of these ghost malls or vacancies, or are we going to see an incremental rise in this year? And if so, how much? Just a brief comment.
Well, in last year, we have seen these numbers shooting up from 57 to 64. Number may not be that big, but the area that they occupied is really huge. Last year, it was barely about 8.5 odd million. It is now about 13.5 to 14 million square feet out of 125. And as I said, almost about 132 more malls are in that category where the times could turn them into an absolute ghost mall. And that number is going to be scary, which is what I said earlier. Unless we do something about those malls which are on the verge of collapse, this number next year when we'll be discussing and talking about it would be very, very scary.
Okay, all right. Maybe it'll be an opportunity for some real estate companies. You never know. But thanks, Ghulam, for joining in and talking to us and giving us that interesting perspective of the rise in the retail sector in some sections and the rise in ghost malls in the other. Well, we need to take a short break, but we'll get you more on the markets. A lot of stocks lined up. Stay tuned.